baby, step right up, because I got a discount from funds from operation for you today, man. You taking a look at medical properties, you think hospitals are the most secure real estate on the planet, and look no farther than Medical Properties Trust. I gotta scroll through the list of hospitals you can now buy at a deep discounted value. The list is damn near endless. This looks really secure and it looked very stable. At least that's what we all thought, but we knew by the end of the day when those interest rates went up after that pandemic slide, whoo, baby, did these REITs get wiped out. And today, obviously, we're going to be doing a deep dive of Medical Properties Trust to take a look at this massive, absurd, juicy dividend of 12.57% to see if is this truly sustainable for those looking for passive income. This reminds me of the Warren Buffett-like cigar butts. If you're looking for some favorable returns, look no farther, because those that picked this up this year, basically right at the beginning of the drops here through February, I mean, you're probably up about 52% on some of that for those that were very fortunate enough to pick the shares up then and not actually back here where the stock actually tanked about 90% and is now trading back toward its 2008 like levels. But the question we got to ask ourselves, does it deserve to be down here? Because today, when the market is tanking miserably, I mean, we're down 1% overall in the S&P, everything is just dropping, yet this beautiful stock is somehow up a whopping 18%. How did that happen? Anyways, if you like medical properties, if you think real estate is something for you, if you're in retirement looking for damn near juicy cash flow, this could be the stock for you. So consider hitting that like button and subscribing for future updates if you're on a path to financial independence to damn well perhaps one day retire early. But let's get into this because, yeah, I honestly think that if you are in a retirement stage and you wanted to add some diversity to your portfolio and just jump basically your income percentage, these are the kind of stocks that can do it, because you can take very small positions and they can contribute pretty greatly to your overall income. But again, that does come with some risk, and you all have to do some due diligence, because I mean, this company has changed and is changing dramatically this year. But they operate in 31 states, over 10 countries, 4 continents, damn it, 555 operators, 444 properties, and 44,000 hospital beds. The largest individual facility investment makes up less than 3% of the total Medical Properties Trust portfolio, which is a tad bit deceiving because the company invests in subsidiaries. They invest in companies that are umbrellas over a variety of hospitals, and that proved to be largely unsuccessful for them because they had a large investment in a business called Steward. And Steward, the CEO running that company, thought he'd be greedy, thought he'd buy yachts, thought he wouldn't care about a higher interest rate environment. Didn't work out for him when he couldn't make his payments. Led to some liquidity problems. Led to the company tanking. And we're going to get into that here very shortly. But we can see, yeah, the diversity here is absolutely bonkers. I mean, the country's they're all over the country, all over the planet. It's a beautiful thing for diversity, which is, I think, what's going to lead to some stability and potentially some continued growth moving forward. If we take a look at Analyst, really intriguing here. Obviously, during February when it was at the bottom, most analysts were saying hold, not a lot of buys, a lot of underperforming. Now, of course, when the stock goes up, that's when the analysts change their tune, because they only want to be right, and they're only bullish when the stock's going up, and they're only bearish when the stock's down. So you kind of want to be buying when this max bearishness has happened. It always seems to be a good indicator to buy, but we're stuck right in the middle here between a low target of $2, a high target of $7, right smack dab in the middle. And you got to remember, there was a lot of shorting going on that's leading to this extreme volatility. The reason we're able to get 20% spikes in a day, give or take, if you take a look at statistics, and I highly recommend avoiding all the statistics because they're going to be skewed. You're going to see like negative profit margins, outsized dividend payments that can't be afforded, and just don't trust any of it. We'll take a look at the balance sheet in a moment. Institutional ownership, I imagine this has changed pretty dramatically with the massive sell-off, but the short interest is at 48% of the float, and basically shares outstanding is about 34%. So when a company like this is able to post good news, like the far greater news that I think people can appreciate, especially with the recent announcement we're going to get into, it's what leads to these massive jumps in the stock, because again, these shorts get terrified. They're worried that they're going to get squeezed out of their position, and when you get good news like that, what do? They have to sell out of their position. They have to close it, or basically rebuy back the shares that they were shorting, all this stuff. They got to cover it. They got to cover the short. And when they cover it, guess what? Boom, pop, to the moon. Not like GameStop. We're not that shorted, but shorted enough that the stock has recognized some of that real upside potential. I mean, again, it's up 53%, and it still looks like it wants to squeeze a little bit higher into the end of the day here. So it's something that's really awesome to see. Now, from a dividend standpoint, it sucks because a lot of people were riding this through the earlier, after 2008 here, the teens of the 2000s. And man, when this thing tanked, I'm sure it hurt a lot of people that were longtime investors in this. But again, we're looking at this as if you were buying it today, not if you were buying it in the past. And this dividend cut was actually a very sustainable thing for, obviously these guys to do, which we'll take a deeper look at. What I also like and appreciate is the shares outstanding haven't been further diluted. In tough times, when companies need liquidity, the first place they usually go is the public market. And this was a company that was diluting shareholders, and this is what REITs do. They dilute to buy properties to build funds from operation and cash flow to continue increasing the dividend. And obviously this hurts a lot for shareholders, but you have to recognize that sometimes this leads to good value, and in markets like this, it led to terrible value. And again, this really wiped out a lot of shareholder return. But in a tougher market environment, the fact that they're not doing any liquidity is a good thing because they're in recovery mode. And I think to some extent, they're doing an okay job. But we'll take a look. So if we get into their assets, first and foremost, keep in mind this is based off their September 30th ending. This has probably changed. They had about $19 billion in assets. You know, they were sitting on basically about $10 billion in current liabilities. Not too bad, right? Total liabilities, you know, 10.7 billion. Not too bad, all things considered. It's a little higher than I'd like to see it, but with the recent enlightenment of the company collapsing, they've been adjusting this pretty damn greatly. But let's just take a look at cash flows here. So we can see that if we skim through revenues, I want to zoom in because you need to be able to see this nice and crisp and clear. Let me zoom my head out of the way. We can see that basically total revenues came in at about 994 million, down from the 1.1 billion, which is actually still pretty stable from a revenue standpoint. We do have to recognize, however, that, you know, some of the aspects like straight line rent has been falling off a cliff, income from financing leases falling. You know, even their interest income is not that great right now because they're probably constantly taking the cash they have, and instead of making high interest income on it, they're using it for liquidity purposes to pay off bad debt. But if we take a look, the interest is going up from 266 million to 308. Whew, for a 9-month ending, man, that hurts, man. To see your revenues going down and the interest expenses going up, with the total expense about 988 million. And again, keep in mind this is almost their entire revenue until you take into consideration this depreciation and amortization. Because as mentioned, if you buy a car and you pay 50 grand for it, and that car takes you to work and starts generating the same cash flow for you every single day, though the car is depreciating over time, but you paid for it up front, let's say you pay for it with cash or whatever, you're not really putting any of that cash flow year over year back into the car, but you can take the depreciation, the value that's dropping in that vehicle over time, and write it off against the income. So you're not putting that extra cash flow to the bottom line because it's not going to get taxed, because the government says, hey, you're losing money on this thing you purchased in the past, so we'll write it off against your cash flows in the future. So if you take that $526 million, you know, you take a look at the 994, they didn't actually lose 988 million, right? Like, I mean, for the cash flow that they generated during this period, if we go take a look at the bottom here, it says they only made 18 cents in earnings against 73 cents in dividends, which make people think the dividends are unaffordable. But again, they had an extra 526 million to pay toward those dividends. So do keep that in mind. This dividend is sustainable. We see it a little bit more accurately on the recent earnings because, you know, in the last quarter here, the real estate from depreciation was about 77 million, but even with that depreciation, they had 19 cents of earnings against about a dividend declared of about, you know, what is this, like 15 cents? So again, keep in mind, you really want to pay attention to the funds from operation here, but you know, I think they have plenty of room to still afford this dividend. I think they're in an okay place for the time being, and they're actually getting in a much better place as we take a look forward. So recently, I just want to read into their fourth quarter full year. I think this was very enlightening. I mean, if you take a look at the net funds from operation was $1.59 for the full year 2023, all on a per share basis, including the NFFO is approximately 12 cents per share of revenue from Steward, the company that we're going to be getting into. It's been a detriment to them, but they've been operating at a net loss of about $1.11 per share. So do keep that in mind. But again, pay attention to that funds from operation there. Now, the fourth quarter 2023 net loss here, you know, 772 million in non-reoccurring write-offs and impairments, primarily related to Steward. Again, they entered into agreement in February to divest 5 hospitals to Prime Healthcare at about 7.4% economic cap rate of for 350 million, and the sale of Medical Properties Trust remaining non-controlling interest in Tenant and 2 under-leased hospitals in South Carolina for combined proceeds of about 17 million. Now, they executed the sale of the syndicated term loan investment in Media, the property or the parent of Priority Group. I thought it was named Priority. In January for just approximately 115 million. Okay, so basically they're saying their primary focus is accelerating our capital and their allocation strategy by pursuing transactions expected to generate $2 billion of incremental liquidity in 2024. So their whole focus this year is to just generate cash. We need money. We don't care if it comes in from cash flow or we're selling. You know, we need that money. We're making progress as evident by our recent agreement to sell hospital real estate to Prime at pricing well above our historical cost and substantially better than the estimates of our implied market capitalization rate. So they are actually selling these hospitals for very reasonable values. They're not like forced out of these. You're selling them for fair value, right? Which is great because it's being added to the bottom line, which we're going to take a look at here because this is Steward. This is what makes up 20 to 30% of their total income. It's been really detrimental to them, and we can see it's about $3.3 billion of medical properties trust investments. It is a very large percentage of their entire portfolio, right? Long-term investment in Steward operates at 11% of gross Steward investment, but if we read into some of the recent stuff going on, they said that, if we can keep getting money out of this, we're going to. If we have to liquidate more of it, we're going to do what we have to do. But it's nice to see that there is developments going on. Like, this is basically the first constructed hospital in Massachusetts in 25 years. It's going to make up 7% of the gross Steward investment. Very interesting stuff. $175 million has been invested to date on the building improvements related to rebuilding. Basically, the destroyed Norwood Hospital in Norwood, Massachusetts. Got $90 million invested to date in the construction of the Waldley Regional Medical Center in this place in Texas. So, I mean, they are moving forward on a lot of these, investments, right? I mean, there's a lot of good to see here that they're kind of pulling themselves out of this rut. And if we take a look at some of the recent news, they've been raising so much damn capital that on this recent news that pumped the stock and caused a bit of a short squeeze was that basically year to date they've raised $1.6 billion and they generated about $1.1 billion in total cash from this recent transaction. And basically they announced that affiliated with a leading multi-strategy, multi-billion-dollar institutional asset manager with proven track record in real estate investments, that Medical Property Trust has retained an approximate 25% interest in the venture, and the fund purchased an approximate 75% interest for $886 million, fully validating Medical Property Trust's underwritten lease base of approximately $1.2 billion. Basically, simultaneous with the closing of the sale transaction, the venture placed a new non-recourse securing financing, providing $190 million of additional cash to Medical Property Trust based on its share of the proceeds, and further confirming the underwritten value. And as mentioned, we've been seeing this a lot lately. There's a lot of big funds like BlackRock that are going out and they're purchasing a lot of these kind of in trouble, I'm going to say, real estate assets from these big companies because they can buy it out for a lot of cash, right? Like, they can put so much cash down, they're not nearly as worried about the interest rate environment. And though they're struggling, that's against debt and higher interest rates. But if they can alleviate some of that and they can buy it in a suppressed market, knowing that interest rates are around the corner, which is what I think they're all anticipating in the next 1 to 3 years, that interest rates cuts are going to persist, that they're going to make a very healthy return on this. And this is what we're saying about net asset value, right? Like, you're getting these either at fair value or below value, in my opinion, though Medical Properties is saying they're getting it for what, the market value is, which in today's market might be a lot less than where the market value could have been. And again, keep in mind, they purchased a lot of these assets years and years and years ago. So even though they might be saying they're selling them above where those asset values were, they might not be much above, right? Like, they could have wiped out several years of value. I mean, so you got to kind of take that into consideration. But anyways, the CEO said the Medical Property Trust approach to underwriting hospital real estate has once again been validated by highly sophisticated third-party participants, and a boarding private market for real estate hospital assets. Our primary focus remains on accelerating our capital allocation strategy, and we are now confident that we will exceed our initial target of $2 billion liquidity transactions in 2024. Based on the valuations achieved on recent transactions and the terms we are actively negotiating for additional transactions. So yeah, the company is looking to get to that point of $2 billion to pay off probably a lot of their crappier debt. It'll put them back into a place of control. And again, from a revenue standpoint, they are seeing a bit of a drop here, but if things start to nominalize out, you're getting a company that's probably not going to be generating $1 billion in cash. I can't see that happening with all the recent sales. This is going to play into a lot of the future cash flow of getting rid of some of these. It'd be neat to see where their cash flow ends up bottoming from a revenue standpoint and just the net rental income. But the company, I do not think deserves to be trading down, back to this 2008 level. I think the company does have some value to the upside. I've been watching a lot of value investors out there put fair price targets somewhere between $8 and $13 on the stock, and I really wouldn't be surprised if we get there at some point. With a lot of I think the headwinds have been dealt with. The liquidity is now there, and I think the short squeeze is starting to persist. I can imagine that a lot of the shorts have already been wiped out, and Yahoo just hasn't updated it because, man, this is a bit of a run here. 53% run is a nice healthy recovery. But I'll pass that question off to you. I'd love to know what you think about Medical Properties Trust in that comment section below.